Developing a business strategy is the starting point of all changes and evolutions we would like to approach in the context of digital transformation. Quite often I hear the expression of a digital strategy as the justification for investments into a digital business. And to be honest, I'm not a great fan of that. There is still a bigger concept of the overall strategic positioning of the financial institution that needs to be addressed first, before actually deciding on the right upgrades along the stages of the digital transformation, as we have seen in the previous chapter. Thanks to the most recent developments in the broader fintech companies, opportunities for established financial institutions to strengthen their market positions opened. But there is no time to lose. My name is Christian Rummer and I am the CEO and founding partner of Q-Lana. We have developed a low-code based open banking, digital lending and asset management platform. Our banking platform is used by multiple financial institutions in lower and middle income countries and by asset managers around the world. In our blog, we will share with you our expertise and ideas about how to organize financial services, how to develop a successful business model for the next decades, how to manage risks, and how to implement all the ideas and concepts at the right speed and sequence. When we think about the traditional roles of financial institutions, we often think about business areas where services like deposits, loans were offered. We think about payment services, wealth management, trade finance, and other concepts. For this blog, though, I want to increase the level of abstraction a little and think about three basic economic functions of a financial institution that have fundamentally not changed and can be a basis for the business strategy in the future. The first fundamental concept is banks take risks. Banks assess and price risks and ultimately earn income, interest income, from taking risk, specifically credit risk. They occupy a key business segment, which is direct loans. While there are some attempts to enter that space by direct lenders and platforms, there is still a core function of the financial institution, that is lending. The second core function is banks bundle and broker liquidity. They collect larger and smaller amounts of deposits from clients at all maturities. They bundle the liquidity and provide loans in amounts that are different from the deposits. And the third function is banks transform maturities. Thanks to the rules of large numbers, it is possible for banks to take short-term deposits and provide, to a certain level, long-term loans. With this, banks can abstract the plans from depositors from the demand of borrowers. Taking these three functions into consideration, the risk-taking, the bundling and the transformation of maturities, and understanding the huge potential of digital transformation, let's have a look at a potential business strategy. Becoming client-centric is an often quoted and very timely strategy for commercial banks that embark on updating their business model. Behind this trend is the recognition that client relationships are the most useful ingredient for business success of a financial institution, especially for those institutions with a local and regional focus. The specific proprietary knowledge about customers, thanks to long-lasting relationships, is a major and unique competitive advantage. It allows the institution to develop and apply a well-adapted customer journeys and provide specific and individualized products. A lot has been written about customer centricity already. If implemented well, the financial institution and its clients build mutually beneficial relationships. For customers, this goes far beyond the mere quality of service, but delivers value added through the relationships. Overall, this will lead to reduced risks, lower costs, increased sales, and higher margins for both customers and the financial institutions. Well-executed customer centricity strategies rediscover the true value of loyalty. We will discuss the steps to create a customer-centric model in a separate session of this blog. The second component of the strategy can be traced to the same characteristics. Thanks to the specific and proprietary knowledge about its customers, the financial institution is in a unique position to measure and manage risks. Banks, specifically local and regional institutions, were always in the privileged position to create and collect proprietary knowledge about their customers. Admittedly, not many use that privilege in a structured manner. Through personal interaction, long-term relationships, and a thorough understanding of the environment, financial institutions are generally better positioned to understand risk. Through their proximity to clients, familiarity with local procedures, and the trust they created with their customer-centric approach, banks are also in the best position for collection and special servicing. To capitalize on these advantages, the bank establishes the methodologies for assessing risks. We will cover the details in a separate chapter of this blog series. Here is just a brief outlook. Through the structured approach to risk assessment, financial institutions will be in a very good position to assess and quantify the probability of default and the loss given default of risk exposures. Combined this with a well-defined monitoring process that includes an early warning system, potential problem loans are identified far before they default. And with this setup, the bank is in a position to price the risks and provide confidence to investors about its ability to handle collection activities. This, in the end, opens the door to selling parts of the risk to investors, for example, through risk-sharing funds, while at the same time maintaining the responsibility for servicing and collecting. As a result, the financial institution is focused on capitalizing its unique knowledge for the generation of revenues, minimizing risks, and optimizing the utilization of equity capital. To establish such a business approach centered around customer centricity banking and proactive risk management, the financial institution must embrace various associated concepts. These concepts will provide the essential structure for organizing and overseeing the institution, ensuring the successful realization of the business model and its advantages. While we provide an overview of these concepts here, we also have prepared dedicated sessions to delve deeper into some of them. First, let's have a look at data analytics. Structuring data analytics in a financial institution requires careful planning and a well-thought-out strategy to ensure that the data is collected, processed, and utilized effectively to drive informed decision-making. As a starting point, it requires to define the objectives and goals that are to be achieved. Specifically in financial services, this brings up the discussions around data governance and management to ensure regulatory and legal compliance. We need to discuss in a separate section the issues around data collection integration, data quality assurance, storing of data in warehouses or data lakes, or both. We also need to cover the issues around the tools, infrastructure, team structure, and skills. Finally, the topics around data security, training, executive buy-in, and last but not least, financial efforts need to be addressed. The second part is process structures. Banking products, despite differing in marketing and sales, generally follow a very common process. For example, for lending, first we talk about client acquisition. We talk about data collection, assessment, approval, disbursement, monitoring, and collection. Certain phases may vary for existing clients. Credit cards simplify disbursement by providing a flexible credit line. Decision formats range from automated to committee-based. Standardizing these steps simplifies new product development, risk assessment, and data utilization. Standardized processes applied to lending, deposits, and other areas align with the customer centricity approach and data structure implementation. We need a platform that allows both simplicity and customization, integrates data analytics, and supports the implementation of a customer centricity concept. As a hint, this is where Q-Lana comes in. Let's talk more about the risk appetite concept. Financial institutions aim to enhance efficiency by optimizing processes. However, when balancing thorough risk assessment with speed, limitations will arise. If we need to make a credit decision every time we apply for a loan, there is a certain time that is necessary. The risk appetite concept offers a solution to this dilemma. This approach involves continuous risk evaluation using data and client interaction. The institution establishes a risk limit for each counterparty based on risk category and size, basically a risk appetite. Additional exposure can be approved as long as the risk appetite isn't met yet or risk can be shared. In this way, you reduce manual processes only for excess requests. The approach streamlines risk and exposure management, boosting speed, flexibility, and transparency. This concept of risk appetite needs to be combined with relationship pricing. Traditionally, financial institutions used fixed pricing tables for interest rates and fees, overlooking the relationship aspect and missing opportunities. In customer-centric banking, pricing is focused on the overall relationship. A pricing model is needed to calculate current and projected revenues for a relationship, a loan, or with related clients. For instance, a loan for a company could be offered at a lower interest rate if all its employees also have their salary account with a bank. The concept of the risk-adjusted return on capital, or RAROC, fits in this concept well. It considers total revenues, direct cost, risk capital, and target returns. The real-time availability of this system of RAROC and relationship pricing enables dynamic client-specific pricing adjustments for the mutually beneficial relationship between the banks and the customer. Obviously, we also need to address an optimized physical footprint. Financial institutions must evaluate the role of their branch networks in a customer-centric model. Optimal physical presence encompassing various outlet types is essential when combining the omni-channel distribution and the branch benefits. Branches still remain crucial for advisory services, but technology can enhance them. Integrating technology creates a seamless experience across channels, utilizing terminals, interactive ATMs, and digital tools. The branch design varies by location and function, promoting direct and discrete interaction. Additional services range from shared workspaces to product displays or video conferencing. Branches can host mobile sales or testing initiatives, even partnering with retailers. In a customer-centric approach, branches become adaptable, tech-empowered hubs. Finally, we of course need to address agile operations. Transitioning to a customer-centric approach and active risk sharing requires adopting a more agile work methodology. The unpredictability and volatility of tasks demand greater speed, flexibility, and alignment among teams. Agile work style prioritizes responsiveness, discarding hindering processes. It integrates people, processes, technology, time, and place to optimize task execution. Agility operates within task guidelines, but without the constraints of how to achieve them. Implementation should cater to the current individual tasks and responsibilities, promoting a positive collaboration among the diverse staff. Let's move over to the tools. With the business model in place and the concepts for realizing the model defined, it is time to look at the right tools for its implementation. This goes beyond the omnipresent core banking software and data analytics structure. The missing link is a platform for workflows and analytics that allows for a rapid deployment, development, and adjustment. A financial institution requires a supplementary origination, loan, and portfolio management platform. This platform supports key concepts such as the data structure, the process structure, risk appetite, and pricing. It handles workflows, decision tracking, client interaction, and monitoring. Analytics are provided via flexible dashboards and reports for management, staff, and business functions. The platform needs to be adaptable for growth and modification, integrating CRM, document management, and risk engines. It needs to be designed openly to connect with service providers and offer customer-centric services, like business management apps for tracking invoices, inventory, or payroll of SME customers. The platform also needs to address all the requirements related to the measuring of environmental, social, and governance components, as well as social impact. It goes without saying that Q-Lana is exactly this platform. Q-Lana is based on a low-code technology which ensures flexible configuration, the ability to adjust and advance over time, and the ability to integrate with other solutions through APIs. Q-Lana is an open banking solution augmented by smart ideas on how to advance banking services. We have prepared an entire chapter about Q-Lana and will present it at the end of this blog series. In a customer-centric setting, fast delivery of almost personalized products is crucial. The demand for innovation is constant, and the old method of a slow 2-year product development process is really inadequate. An agile approach to product development is necessary, enabling quick idea generation and a potential modular construction. Creation, testing, approval, and launch must occur in rapid succession to support high personalization. This requires an established agile operation concept, a platform for swift analytics, and customer feedback integration. This brings us to the topic of partnerships. A financial institution is dedicated to implementing the described business model. This involves various ongoing initiatives while sustaining existing revenue and client relationships. To effectively tackle the challenges, partnering with implementation experts familiar with the model, concepts, and systems is recommended. Their experience can aid in navigating pitfalls and challenges, ensuring a successful execution. At Q-Lana, we have this skill set and offer it to our customers. We finally come to the idea of risk-sharing partners, because central to the business model is risk-sharing with investors. To engage these sources of risk capital, the financial institution should collaborate with funding providers or risk-sharing managers. Fund managers can create specific investment funds, open-ended or closed-ended, to mitigate loan exposure risk. These funding providers also offer guidance on asset structuring, pricing, and sales strategies to optimize risk reduction. This is the reason why at Q-Lana we have created our subsidiary Q-Lana Investment Advisors, which is preparing the SME Lending Fund. We will also have a separate chapter about that topic. With this, we have introduced all the components of the business strategy as we see them ideal for a local or regional financial institution. We can work in this direction and build with you a customer-centric, risk-conscious entity that builds its success on advanced data analytics and structure. In the next chapter of the blog, we will talk about specific components of this business strategy in much more detail to complement our arguments. We look forward to seeing you in the next chapters.